Welcome to Subramani. I have noticed over a long period of time that one of the worst things that a person can do while investing is be overconfident. When you don't know, you ask. When you think you know and you actually don't know, you harm your portfolio dramatically. You go and pick up shares which you perhaps should never have even looked at, right? Or from, I don't know from where this overconfidence comes, because I was just reading some book on how a little young girl, 4-year-old, was lost in the forest, and for 2 days she was not found, but one day on the third day her dog had wandered to the village from where she had gone, and the rescuers traced the dog and found her alive. This was 2 days in the forest, and she had eaten some berries. She was perhaps hidden under the grass because it was a place which had wolves and bears. So obviously she escaped the wolves, and the bears did not smell her. Maybe she ate some berries, she drank some water, when it was very cold, she cuddled up with her dog. Whatever she did, she was not overconfident, nor did she create some mental map and kill herself thinking, oh, it's too cold, I have to die, I can't survive. She was just 4 years old, so she was able to do that. Now, I noticed that when an investor is either very sophisticated, he is a CEO of a company who knows that he does not have the time to look after his portfolio, or he is the CEO's peon, who knows that he does not know what to do. So he would just start an SIP and stick to it. He will not get into, oh, the market is high, should I stop? Market is low, should I now put more money? Just does not get into that. He has been told that if he puts 500 rupees and he increases by 10% every year, he will accumulate money. He will just do that. The advisor has to go and tell him, no, don't put in this fund, put in that fund. Oh, you are putting only 500, now you can put 1000. It is completely up to the advisor to make those changes. So this overconfidence is called, it has got a name, but more important than that, we see that very commonly among investors too, right? The Dunning-Kruger effect, right? So first you think, oh, I know everything. So first you start with I know nothing, then you read some websites or maybe watch some YouTube, then you think you are here, and then you realize that you are not there. You make some mistakes, you buy some share, you lose money, you are very overconfident, takes you 30 seconds to analyze a company, you buy the company, you lose money. Worst case, you even make money. Then you realize, oh my God, this marketing, I mean, this is a very simple thing, right? Anybody can do it. Until you lose money, and then you realize, oh my God, I can't. So should I do indexing? Should I put money in a mutual fund? Should I go to an advisor? What can I do? And then you realize that, oh, first of all, you need a term insurance, you need an index fund. You start there, and then you say, oh, the small cap funds are doing better than mid cap funds, or things like that, right? So first of all, the overconfidence comes, I don't know from where, but maybe from a family where others have not invested. So when you start investing and making money, people tell you, wow, you are a genius, you're doing so well, you're great. Also, sorry. The bull market makes all of us overconfident. Anything that you buy goes up. All right. So here is a share which you never thought it will ever make money, but that has also gone up. You bought it at 6 rupees, now it is at 8, or it is at 9. You sell it off, it was 1000 shares, so you made 3000 rupees. Now you start tapping yourself and just saying, oh wow, this is very simple. All I have to do is buy in the morning, sell in the evening, and make some money. So many new accounts have been opened, right? So 6 crore accounts or something have been opened, and all of them have a balance less than 10,000 rupees. Where have they got this confidence from? YouTube, social media, reading newspapers, whatever. Somewhere they've got the confidence that they can do their own trading. Maybe some of these people are investors in mutual funds, etc., but here trading, they're very confident that they can do it themselves. Then you go and pick up the data that 99.4% of the volume that happens in India is trading, F&O, etc., and that 90% of the people who trade make losses, right? Does this deter people from entering the market individually on their own? No. Am I saying that they should not enter? No, not at all. I'm very happy I own shares of companies which have broking companies, or own banks which own the brokerages, and I'm very happy with the revenue that is being generated. Yes, of course, if Zerodha were listed, I would have happily bought it. But Zerodha, Grow, Upstock are all people who are opening a lot of new accounts and doing well. So much so that some of the bigger, older brokerage houses are now feeling miserable that they missed the bus. So they are copying the similar things. They're launching new zero brokerage, 20 rupees brokerage, 5 rupees brokerage, all kinds of things are happening. So yes, some of the old ones have missed out. So how do you tackle with this overconfidence that people have? A lot of fund managers that I have met have been overconfident about their portfolios, and it is easy to pick one or two shares and ask them why are they so overconfident about those shares, and they really don't, they actually cut a sorry figure. So these kind of things happen, you see this happening. It's not as though you have never seen such things happening. And LTCM was a great example of a bunch of Nobel Prize winners who were overconfident. There have been shares which to me look terrible from outside, like Yes Bank looked terrible at 300, 200, at 85 when they did, yes, big fund managers did invest in those shares at those prices. So sometimes you are overconfident saying, oh, I know more than the retail guy, but sometimes it is a retail guy who is so overconfident, who has no clue as to what he is buying or what she is buying, and then after some time they came, I know somebody who bought Suzlon at 100 rupees with her retirement corpus, right? I know somebody who bought Yes Bank at 300 rupees with their retirement corpus. The kind of risk that people take without understanding that they are taking risk is not something new. It's something which you have seen quite often. So how does one control oneself from being so overconfident? First is to ask yourself, do you understand anything about that industry at all? Do you understand what is the product, what is the pricing? Must clients definitely come and buy, right? So if it is, for example, if it's a company like ITC, you know that even when you tell the customer, look, smoking is injurious, you will die, there's a photograph of a skull, and people still buy, that is some kind of addiction, then you can be sure that the company will always make money. Or somebody like Hindustan Unilever has got enough products which people will buy. So it has pricing power in a few products. It does not have pricing power in all the products. But yes, wherever they have pricing power, they make a lot of money. So you know some of these facts, but it does not mean you know whether the PE is right. Is it a good time to buy that? If you don't know, then maybe you should not be there in direct equities. Maybe you should go into mutual funds, right? So first of all, ask yourself, have you ever thought that you have done things wrong because of your overconfidence? If you don't, then there is the first problem, that you don't even admit to yourself that you are overconfident. That is the worst case scenario. So what all should you do? First, ask yourself how much time have you spent in understanding that company. I'm assuming you're buying a company, or the understanding that fund. Ask somebody who hates that fund. Typically somebody who is a short seller will tell you why they think HDFC Bank is a good share to short sell. Then you know the reason why. There is somebody who has a view contrary to yours, right? It could be ITC, it could be Reliance, it could be HDFC. It could have spent 2 years, 3 years doing nothing, and you think 3 years it has done nothing, so it's a good share to buy because I know that the reversion to mean will happen. Please understand, reversion to mean happens in the portfolio, not in a single script. A single script can be there for a very, very long period of time. It can completely exhaust you and then make its next move, right? Next move up or next move down, I'm not saying, but it can make it next move after a very long time. So you have to factor that also in. Question more than you normally do, right? So if somebody comes and tells you that this share is worth buying or this fund is worth investing, ask more questions than what you currently do. What gives you the confidence? Why are you so sure, right? So ask all those questions and be ready with one question. What if I am wrong? For example, if I think share is worth buying at 80 rupees, let's say Zomato I think is worth buying at 80 rupees and currently it is at 105. I can do two things. I can wait till it comes down to 80, which it might after some time, or it may not. Or say, what if I'm wrong? So I go and buy some shares at 105, and then wait for it to hit 80. Maybe it doesn't hit 80, maybe it hits 90, and I say, okay, that's the closest that I can get, so I buy at 90. Or be extremely confident that your valuation is right or your technical chart knowledge is right, and therefore you will wait till 80. All these things are open, but don't be overconfident saying, oh, I know that it will come down to 80 and I will wait. It may not come down at all. It may come down to 90 and then go up to 130 and 140. Then you know you've lost it. So understand and ask yourself one question: what if I am wrong? So similarly, don't commit too much of your money to one share. Diversify, have a big range, have not more than 1% in one company to start with. Then when you're confident, make it 2, 3, 5 and go to a maximum of 10. After you go to 10, never buy more than 10% of your portfolio, or some such rule that you make for yourself. And then when the value goes up, you say, okay, 10% is max I will put, but 20% is the max at which I'll start selling. So my in one share in my portfolio is 20%. So every rupee that it goes beyond that, I keep selling. Maybe I sell 100 shares, 200 shares just to keep it. I have 20,000 shares, but I keep selling 100, 200 because the price keeps going up. But I then if the other portion of my portfolio is also going up, then I don't have to worry. But if the other portion is not going up and this is going up, then I have to reconsider as to whether I want 20% or 25% or 15%. Check all that. So your overconfidence has to be broken by seeking the views of people who think completely contrarian. I have friends who don't invest in equity. They largely invest only in real estate and debt. So when I ask them, and they're very confident about real estate and very pessimistic about equity. So all these things happen. So collect data from a lot of people, ask the views from a lot of people, diversify and have your own rules and regulations about how you will invest. Once you do all that, you can battle your overconfidence. You will never overcome it completely. So necessary to take all these steps to control your overconfidence, not eliminate it. Thank you.